Why does the AI boom, which seems like it only benefits Nvidia, quietly have the power to revive Intel's CPU empire after years of crisis? Stay until the end of this video to discover why AI infrastructure is more CPU hungry than ever, and why this very game could become the lifeline that brings Intel back to a leadership position nobody expected. Back in 2024, Intel went through a period where investors ran out of patience. Strategic missteps, an AI roadmap that lacked sharpness, falling behind in competition, and a wave of layoffs. The stock fell hard, confidence cracked. But then in 2025, something made the market change its tone. Intel's stock surged as much as 84%, while the benchmark semiconductor index, the SOX, rose about 42%. That gap is not small. It signals one thing. Wall Street isn't just looking at the present, they're betting on a turnaround story. And now, all eyes are on Intel's Q4 earnings release, after the market closes on Thursday. Because this is the test of whether CEO Lip-Bu Tan's promises have actually started to take root. Intel isn't turning the ship alone. The market has been talking about major investments that strengthen the balance sheet and give Intel the runway to reshape its manufacturing and AI strategy. Specifically, Intel received $5 billion from Nvidia and $2 billion from SoftBank, along with participation/recognition from the US government. The impact of that capital isn't just making the books look better. It gives CEO Lip-Bu Tan something even more important: time and options. Because a turnaround is not a one-quarter miracle. A turnaround is a multi-front war, rebuilding the organization, fixing manufacturing capability, and most importantly, having a market big enough to support revenue while restructuring is underway. And this is where AI data centers come in. Most people hear AI and immediately think GPU. But building an AI data center doesn't just require GPUs. It also needs server CPUs as the foundation to handle system workloads, manage infrastructure, coordinate operations, and run many tasks that don't necessarily need to be pushed onto GPUs. That's why the data center boom can create strong demand for Intel's traditional server chips. Forecasts for the quarter ending in December suggest Intel's data center business could grow more than 30% to around $4.43 billion. That's a number heavy enough to change market perception because it hits exactly what Intel needs most right now, proving they still have a real revenue engine in the AI era. Not only that, some analysts even argue Intel's biggest bullish case is the ability to raise server CPU prices by double digits in 2026. In other words, not just selling more units, but selling at higher prices if supply and demand tilt in Intel's favor. And here's another thing that's pulling investor attention. Over the past 2 months, at least 10 brokerage firms have raised their price targets or upgraded their ratings on Intel. When Wall Street raises expectations in unison, it's usually because they see positive signals forming. But hold on, Intel still has a major risk zone. On the consumer side, Intel is still under pressure. PC market share is being challenged aggressively by AMD and the broader ARM-based ecosystem. And on top of that, the PC market could be held down by something that sounds very ordinary: rising memory prices. When memory chip shortages drive prices up, laptops become more expensive and demand can slow. Analysts highlight that memory accounts for about 25% to 30% of a PC's total bill of materials, meaning even a modest increase in memory prices can disrupt the entire cost structure. UBS even expects global PC shipments to fall 4% in 2026 instead of growing as previously forecast. If that scenario plays out, Intel can't rely on PCs to pull the whole ship forward. Still, Intel has one card to reduce the damage: new products. Intel has started shipping a new PC chip line called Panther Lake, and this is the key point. Panther Lake is the first line built on Intel's 18A process, a technology widely seen as make or break. But 18A isn't just a number. What has engineers paying attention to is a critical technology: backside power delivery, moving the power delivery network to the backside of the chip, reducing congestion in the front side interconnect layers. Intel calls its implementation PowerVia. The benefits are practical: higher performance or lower power consumption. In Intel's early testing, PowerVia delivered about a 6% clock speed uplift. 6% doesn't sound explosive, but in the CPU world, that kind of gain can make a meaningful difference, especially for laptops where power efficiency is make or break. And strategically, Intel is believed to have deployed backside power delivery ahead of TSMC. TSMC is expected to bring a similar technology to its A16 process in late 2026, meaning Intel may have a 6 to 12 month advantage. In semiconductors, 6 to 12 months can be an entire product cycle. If Intel executes well, it can turn a time advantage into contracts, customers, and restored credibility. But there's a cold reality you have to remember. You can have an excellent process on paper, but high-volume manufacturing is the real battlefield. Intel's challenge with 18A is yield the percentage of good chips per wafer. There have been reports that only a small portion of chips produced on 18A meet the quality bar for customer supply, although Intel says yields are improving month by month. And when yield isn't optimized, the cost shows up in the financials. Gross margin gets squeezed. Forecasts suggest adjusted Q4 gross margin could drop by about 6 percentage points to around 36.5%. This is the core issue. Intel may grow data center revenue and have attractive technology, but if margins stay weak for too long, the market will ask, is this turnaround actually sustainable? Let me boil it down into 3 things. Remember these. First, is the data center business truly accelerating? The key target is about $4.43 billion, up more than 30%. If Intel meets or beats that, the narrative AI data centers are pulling Intel back becomes much stronger. Second, gross margin and yield signals. 36.5% is a low forecast. The market will scrutinize whether Intel clearly discusses the direction of 18A yield improvement and when margins could begin to recover. Third, signs of foundry customer traction. Intel doesn't just want to manufacture for itself, it wants to attract external customers. Any positive updates on manufacturing tests or potential customers would boost confidence in the long-term strategy. So is Intel coming back to life, or is it simply riding the AI wave? If you ask me, Intel has a rare window of opportunity powered by the data center wave and by real technology progress like 18A and PowerVia. But that window will close fast if yields don't improve and margins stay compressed. If you found this video valuable, hit like, drop a comment below, and subscribe so you don't miss the next videos.